Hey guys, welcome back to Click Capital, your go-to channel for all the latest market analysis, data and charts, where I'll share my insights with you from 20 years of trading the markets every day. Okay, so we had another update in the markets. I'd come in a little bit net short today, 20% net short. Stay at the end of the video, I'll let you know how I'm positioned going forward. We've got the big Fed day on Wednesday, where Jay Powell is still expected to raise rates by 25 basis points. But we've still got a lot of fear out there with this ongoing banking crisis. So let's just go dive in and take a look at So much a sea of green out there, except for Microsoft that came off, Google and Amazon. Pretty much every other sector was green today. Fear and greed ticked up a little bit from 24 to 29. And options, a lot of calls being still bought out there, 70% on Amazon, 62% on Bank of America, and a lot of the banks still being actively traded as well. Over to dark pools, and we did see them buy the dip on Friday, 50%, which is a bullish reading. So dark pool buyers are active here. However, we've seen corporate insiders sell a lot on Friday. They outweighed buyers by more than 2 to 1. So that's been picking back up. And we saw that in early March, a lot of corporate insiders selling their stock. So they've been pretty active on Friday. Over to Max Payne. We've got Max Payne this Friday, a little bit higher on the SPY at 395. And into April's regular expiry, a little bit higher at 398. And March, the second half of March has been typically bullish for stocks this past 20 years. So you can see from the 16th onwards, it ticks up, and that weakness of the first half we've had. So let's see if stocks follow the same pattern over the last 20 years as well. And energy stocks may have turned. So here's a monthly chart of the energy sector ETF. And since it bottomed October 2020, we've had a pretty good run up for over 2 years. But the MACD got to its most overbought reading ever and is just turning down. And you can see the sector has significantly underperformed the S&P since mid-2008 and bounced back the last couple of years, but looks to be rolling over again. And will Warren Buffett save the day? Talking with the White House, maybe coming in on banks. Some of you may remember he did the same in 2008, came in and injected capital into a few banks and got himself a really great deal on preferred stock with a huge dividend and a really high premium price. They'd have to buy back the stock from him, and made billions and billions of dollars in deals no one else could organize except himself. But I mean, the political social climate's a little different since GFC. It's left a sour taste in a lot of people's mouths since then. So if he comes in and organises some really great deal for himself and his shareholders, that might spark a little bit of public backlash. So I'm not sure if he will get that involved. He may, but it probably will be on maybe less lucrative terms. He does have a lot of shares in Bank of America and American Express and has always been invested in financials. So it's in his interest to see the sector survive and thrive pretty well. So this could put a lot of confidence back into the sector and into shareholders and deposit holders as well. But I'm not sure if he's going to be able to get these, basically extract a lot of billions from regional bank shareholders into his own pocket. I'm not sure if he's going to pull that off as well as he did back in the GFC. Al Loran, a really economist that I respect a lot. I think he's always really realistic about what's going on and has good, unique points. He's saying that the Federal Reserve needs to go ahead with a 25 basis point hike because the worst thing they can do is blink in the eye in the front of financial instability. And I agree with him. If they pause, the markets might react even worse than that, even though it's taking pressure off the banks and, maybe seeing the top of the interest rate hike cycle. It might show that the Fed's really worried about what's going on in stability and they think it's going to get worse. So, I mean, there's a lot of people on both sides of this. People saying they should, people saying it's going to be a huge mistake if they do. There's quite a lot of strong opinions on both sides of the fence here. And 17 billion wipeout of Credit Suisse bondholders has not gone down well in Europe. So even though the Swiss government organised a deal for UBS to take over Credit Suisse and, essentially rescue them from a death spiral, which has been seen as a bit of a positive from markets, what's happened is equity and bondholders have been completely wiped out. So what does that do? For other equity bondholders in other banks around the world, they're going to look at this and go, gee, we're really at risk here. Bonds have been taken down to zero. That's going to spark a lot of more fear in equity and bondholders and banks around the world if this is not over yet, which it doesn't look to be, because this is just the latest domino to fall in this ongoing crisis. So overall, I view this as a negative. And China's Xi and Russia's Putin meet together in Russia for 3 days and look to be getting closer in their ties, and this is just adding more and more geopolitical tension as China seems to think it's going to be a good move for them to get closer with Russia. I heard someone say over the weekend that long-term China really wants Russia, so they kind of could win either way. If they somehow manage to push the West away and win their war in Ukraine, then that's good for how China's seen on the world stage. And if they don't, if this does escalate and Russia does lose, then that might be good for China too, because they might better go in and take some territory or some resource assets in Russia. So I wouldn't be surprised long term if China's got its eyes on Russia. And now Russia's completely dependent on China. So China kind of owns Russia, because Russia needs China a lot more than China needs Russia, because Russia needs China to buy all of its stuff, as the West doesn't want to anymore. But end of story for us investors and traders. This just adds to the geopolitical risk in the background that's always there for markets. Fed fund futures are pricing in 75% chance of a hike, which I think is right too, and that's what I'm sticking with. Unless anything really bad happens tomorrow, I think Jay will go ahead with a hike. He's got to show confidence in using monetary policy to get on top of inflation. They can use other tools to handle stability in the markets. So I think he'll go ahead with that. Otherwise, markets should sell off pretty hard if they do blink. Okay, so over to the charts today. Pretty good day for risk assets across the board. We did see a bounce in mid caps and smalls, and the Qs were actually up the least, but still consolidating here above their 50 bar. Internationals look to be trying to be putting in a bottom here. We've got Canada, the FTSE on a big hammer and divergence. The DAX similar as well, bit of a hammer there. The Nikkei just holding, ASX similar, and China as well. So markets look to be trying to put in a bottom in their oversold state at the moment. But in my opinion, they're still mispriced for where volatility is. So we actually had the VIX make a higher high and higher low today. We got up to almost 29, and when you look at where the S&P 500 is for a VIX at 29, this has got to be one of the widest spreads between what we're seeing in price action and the VIX that I've seen for a while. And 3-month and 6-month VIX is elevated as well, so we're not just elevated up the front, which we're still on backwardation right at the front from 9-day to VIX. We're still higher. So that's still in kind of like a crash mode. And the market's also saying volatility is going to be higher for longer. And we're still seeing that in the MOVE index, bond market volatility, really elevated here at 182. We are not out of the woods yet with this whole banking mess. And no one seems to be buying puts today. We've got the equity only put call ratio down at 0.71. So a lot of people buying calls into all of this. Breadth data has got 29% of stocks above their 20-day average, only 19% above their 50-day, and 37% above their 200-day. And the price action in those two are really weak. So under the hood, not looking at just the mega cap tech dominated indices, most stocks there are still under a lot of pressure here. And we don't have many new stocks making highs either. This is really low down here at 9 and 13 for the Nasdaq. Spreads came off a bit today. just consolidating. The equal weight versus the SP made a new low again today, and high beta versus low volatility came off. Growth versus value came off a bit, but still really elevated up there, and so did tech versus SP, which looks to be really elevated up here at the moment. And saw a little bounce in smalls today, but they sold off towards the end of the day. Over to the yield curve, pretty flat up there, negative 0.48. And high yield versus treasuries, pretty flat, trying to make a bottom as well. 2-year hanging around at 396. 10-year looked to have maybe found support at 340. This is just kind of, I think the rates are just all hanging around waiting to see what the Fed's going to do on Wednesday. So it'll probably be a bit sideways and quiet tomorrow as well, waiting for that. Treasuries came off a little bit, but still in a bullish pattern up here. We could almost call this a messy kind of bull flag, where it's just gone up, ripped up and holding. And high yield actually was lower highs and lower lows today. So still bearish there underneath the 50 bar, but could be building some sort of divergence here on our hidden divergence indicator. Dollar came off, finished on its lows, and is looking weak here. And the euro seems to be holding. And Bitcoin actually made it over 28,000 over the weekend. And you've seen me make a pretty bullish argument for Bitcoin and why this can continue. So the next, if we go out to a 3-day, we do have this resistance around the 30,000 level here that we've bounced before. So we've had a few turns around that 30,000 level. And being a big psychological number, I expect that to be the one. So we may bounce off it, like we bounced off here at 25,000. It looks like the market kind of hit it and came off in a bit of a shooting star, but it never confirmed. We never got a lower close underneath that. So that's broken through that and denied that. So that's broken through that and negated that signal there, and looks to be consolidating. I'd say we're at least going to go up and test 30,000 this week and maybe consolidate, pull back, and could potentially keep going higher with that if this banking crisis continues unfolding. Commodities had a little bounce here, but is pretty weak. We're underneath this big support zone here. Copper had a nice little bounce today, and gold, a bit of an inside bar, consolidating up the top there. And still the most bullish sector in the market at the moment, in my opinion. Silver looking to catch up as well. Oil had a bit of a bounce here today, but is pretty weak trading down here. So I'm not sure this is a bottom just yet. I'm not willing to call this a bottom. And there is no divergence at all either. Natty gas all over the shop as always. Agriculture just kind of sitting there, and uranium as well. So commodities overall, except for gold, are looking pretty weak. Over the stock sectors, pretty green today. We're only off in transports, IPO, ARC, and clean energy. Bots did okay, just holding up there. And we had a bit of a pop in oil and gas. And materials, gold miners did well again. Industrials just holding there. I'm not sure if we're making a bottom here. Home builders and defense stocks as well. And we'll look at utilities just consolidating up there. And financials. Looks like they're trying to make a bottom here on the regionals and financials. But I'm not sure. I mean, the dominoes are falling fast, aren't they? I mean, Credit Suisse was the latest one. Have we seen the last of it? I don't think so. Looking at volatility and bond market volatility and credit spreads, I don't think this is over yet. BlackRock ticked up today. And we do have a bit of a divergence building here, so that is good for the overall in the stock market to see BlackRock kind of look like it's putting in a bottom here, but it's still too early to say whether this is going to confirm or not. So we'll keep an eye on that. And JP Morgan as well. I actually took a short in this today. I don't think it's over yet. It's not diverging. Looks like it's trying to put in a bottom here. And JP Morgan has been holding up the best against all the other banks. But I feel like something could just still crack here and we can fall off harder. But let's see what happens. Apple. You've been watching my channel and you knew I thought this is going to break, and it looks like we are here. We've got this nice divergence and coming up to this big support that we've had here for quite some time, and we've closed above these wicks here So for now, it looks like mega cap tech and Apple has been the place to hide out. Microsoft did get really overbought here on Friday. You can see it reached the top of our buy-sell band. It's got this big divergence on our hidden divergence indicator, and we're still ranging here, so it's not a strong trend. And we've came off hard today, 2.5%, so I think this could trace back to its 50 bar VWAP as well. And Amazon just looking weak there. Google had a little bit of pullback, came off this big little double bottom divergence here. And Meta, it's really stretched up here. Got to put in a big bearish divergence on Meta shares, so I think Meta might be a bit stretched here. AMD, hold on, did a big hammer formation, and Nvidia, similar as well, just sitting up there. Netflix just hanging around. Tesla came up, but kind of couldn't take out yesterday's highs with any conviction and stay there, kind of bounced off and came back down a bit. So I'm still short Tesla. Coinbase sitting up there with Bitcoin, and AMC and much of the other meme stocks came off. And look at Big Bear, all the hype's just come out of that. So last month we're up at 650, now we're at 150. And the others as well getting hit hard. Credit Suisse, look at this, down 52% today. Remember me said back here on Friday, this is now dead. They've been rescued by UBS. And normally what happens when another company takes over the one, the acquirer gets sold off and the acquiree shoots up. But in this case, it's been the complete opposite. So this is a complete rescue deal. And let's look at Credit Suisse on a 3-month chart. So from the GFC, before the GFC, we got up to $77 a share. We're now under $1. So it's completely wiped out equity holders and now bond holders as well. So this doesn't put a lot of... So while this helps, overall financial stability in the system, this is showing all other equity and bond holders and banks around the world what can happen to them too. So this just adds to the fear. And now this is like, you could say this is the fourth domino to fall. What's going to be the next one? Maybe First Republic Bank, because, JP Morgan, Jamie Dimon led, 11 banks to deposit $30 billion into First Republic back here. And one would think that would completely restore confidence in the equity and deposits, and we'd be shooting back up to $80 a share in no time. Instead, on Friday, it sold off 32% and another 47% today. So this thing looks like it's going towards a death spiral as well. And once something gets hit this hard, it kind of becomes structurally broken. And, the banks might actually start worrying about their $30 billion, or they might try and backstop it even further. But what if we see another regional go the same way? They can't backstop it all, then things could get really nasty really quick, as this is still a really fast-moving train they're trying to get in front of and stop. But it just seems to be a lot of equity and bond holders just losing faith really quickly, and we can see that in the price action. Bank of America, similar. It looks like it's trying to put in a bottom. It's holding here, but I'm not sure whether this is a bottom yet. And Wells, here's some of the other regionals. Starting to put in little divergences here, but it's still too early to call a bottom here on these guys. I think it could just get a lot more messy before it gets better. And there's Schwab as well. Okay, so that's a bird's eye view at all the markets today. There's a lot of liquidity. We can see this on the global net liquidity model. We're actually at 39.89, above where the market is at the moment. So the Fed is pumping liquidity. Their balance sheet's increased. A lot of banks are borrowing from them, and that is putting a bid in the market. However, there's still a lot of fear out there, and we can see that in the VIX. Markets are on edge, and we can see that in bond market volatility as well, up here at 182. And we can see that in breadth under the hood. things are weak. So while we look to be trying to put in a bottom here, it's just things could still crack open here, and that could happen after the Fed decision on Wednesday. Either way, whether they hike or not, it could be bad either way. It's kind of unsure how the market's going to react to either of those two situations. So for now, I just increased my short a little bit to 40% net short, and I'm long gold, and I'm long treasuries as well, and I'm short JP Morgan and a few other high beta cyclicals. So 40% net short, but as always, there's still bids in this market, but I feel though there could be some worse headlines still to come out, and this market could crack open. But we'll see what happens tomorrow. I expect tomorrow kind of to be a wait and see day, just kind of sitting there and waiting for the Fed decision on Wednesday, which will be the big one. All right, guys, thanks for tuning in again.